Hi, welcome to this online session from Impact Taxation and Financial Services. In this session, we're going to have a look at why property owners in Australia are paying too much tax. Okay, I think this issue a lot of property owners are facing, and let's have a look in this session. Okay, this is a brief introduction about myself. You can pause the video to have a detailed look. And before we go to the main content of the session, I just want to mention that the information provided is for general information only. If you do want to need some professional advice or before you make any decisions, please talk to one of the professionals in their special field. Okay, so let's have a look at the reasons why property owners are paying too much tax. Okay, the first one, it could be lack of consideration of different ownership structures. All right, and different ownership structures, they actually have very different tax rates and treatment. So because of that, the planning strategies could be very different and the different structures. Okay, and then if you want to find more details, please watch our YouTube session called How Should You Own Your Assets and Investments? We actually provided a lot of details in that session on the difference between all the popular structures and their tax treatment. So I've listed four most popular structures in Australia: individual company, family trust, and SMSF, self-managed super fund. So let's just use two of them to give you an example, why, how they can be different. So let's say, for an example, for an individual, if you are generating tax loss from rental property, okay, from the rental income from year to year, then you can actually use the tax loss to offset other income to reduce your overall tax. Okay, so your other income can be from your employment income or from a sole trader business. Okay, so you can actually utilize the loss that way to help you to reduce tax. And then, say on family trust side, okay, you can't actually utilize the income tax loss in the current year. It can only be carried forward to future years to offset future income. Okay, so that's the main difference. All right, but when there is a tax profit, okay, for an individual owner, okay, they have to add the profit on top of all their other income and pay on the marginal tax rate on the rental income. Okay, and then but for a family trust, the trustee can actually distribute the income to different family members, okay, to help the whole family to reduce tax. So you can see that how it can be really different, okay, for different structures. All right, and then another possible reason, it could be a lack of long-term planning. Because as what we have mentioned, the how family trust can distribute profit, or how because when you attach the ownership to an individual, unless you do some structural change, the individual will be stuck with that part, that portion of the ownership or tax income or loss. But what if in later years, okay, the income level changes? Okay, so from retirement, from unpaid parental leaves, or some people might want to take a gap year from their employment, just go travel around the world for 1 year, or they might have children, they want to stop a couple years to look after the children. Okay, so all that should be included in the initial planning. Okay, so then So that's why long-term planning is really important. And then, in a family trust scenario, children within the family, grandchildren, they can grow up to more than 18 years old and can be included in family trust as adult beneficiaries. All right. And then to have that $18,200 initial tax-free threshold, okay, to help the family to reduce tax. And then also a question you might want to ask yourself, do you need the money now or before retirement? If not, would a SMSF structure be better for you to save more on tax? All right. Of course, the question is based on if so let's say this happens to a lot of especially high net wealth people. They might have a lot of income, they have plenty to cover their daily living cost. So sometimes people might mention, oh, I don't need the money now, I just want to invest it. And then but sometimes they invest it outside the super fund environment and actually paying up to 47% on tax. And then on the other side, within a self-managed super fund, you're only paying 15% on income tax, okay, so rental or tax profit on rental income, okay, and only 10% on capital gains tax when you are selling the property in the future. You can see how big the difference is. And then the issue is sometimes I ask some of our clients, their plan is actually to utilize the investment to support their future retirement, but they're still investing money outside the super environment, okay, to pay a really high marginal tax rate. Okay, so sometimes that's the reason why long-term planning is really important, because you need to match the timing, okay, from your investment purpose to when you need money. Okay, so if it's a long term, then because the downside with a self-managed super fund, once you put your money there, you can't get it out, okay, until retirement or for compassionate reasons. Okay, so you need to match your investment to your purpose as well, okay, the timing and the tax planning as well. Okay, all right. And then another possible reason, lack of combination of both income tax and capital gains tax considerations. Okay, so when we look at income tax planning strategies, when the property is giving you a tax loss, you might want to allocate more ownership to high income earners. Okay, when it's giving you a tax profit, you might want to allocate more ownership to low income earners. All right, as what we have explained before, when you have a tax loss, that loss will help the high income earner to reduce tax on the other income. All right, and then on the capital gains tax side, that's when you're selling the property. Okay, when you're having a capital loss has to be carried forward to future years to offset future capital gain. Okay, and then capital gain, you can it's going to be better if you can allocate more ownership to low income earners, or when in a family trust, streaming, okay, this is called income streaming. You can stream the income to low tax rate beneficiaries, or sometimes you can pick and choose people who had capital losses before. Okay, they can actually receive the capital gain first to help the family group to reduce overall tax. All right, then so the strategies can be conflicting with each other. So let's say I actually have an example here. So when a property gives you tax loss to save income tax, more ownership should be given to high income earner, okay, because that person got a higher marginal tax rate, okay, and he's going to save more on tax when he's receiving more tax loss. But what if when the property is sold, the high income earners still have the same level income? Of course, because you're stuck with that portion of the ownership, you also pay more on capital gains tax. So that's actually the dilemma, because the two sides, income tax and capital gains tax. Income tax is from year to year. Capital gains tax is when you're selling the property. Yeah, the strategies on two sides could be conflicting with each other. So what can you do? Yeah, but I'll show you the solution. Yeah, we can provide you later on. Okay, so then also another possible reason is lack of correct understanding of tax law. Okay, so at the time of purchase, or when a property is being converted to an investment property, it happens quite often. Sometimes people live in a residential property for their main residence. Okay, maybe they want to get a bigger house to live in and then change the last residence to investment property. Okay, so before the change, they should consider some possible planning strategies. Okay, the timing of R&M. R&M stands for repair and maintenance expenses, loan structure, etc. So please refer to our YouTube session, 10 things you should consider before buying a property. In that session, we actually explain everything in great detail. What possible tax traps you should try to avoid to help you save tax. Okay, so but you need to act proactively. Okay, maybe before you buy the property. Or later on, if you need to change it, you can change it too. But yeah, you need to find a good tax accountant to help you with the cost benefit analysis. We'll mention a little bit later in this session. Okay, then at time of sales, okay, incorrect timing of sales, that can actually cause property owners to pay a lot more on tax. So some examples here. First example, selling multiple properties with capital gains in one tax year. Okay, so this is actually can be quite damaging or costly for taxpayer. I remember a couple of years ago we had a client I remember it was in April. He contacted us. He said, "Oh, I just want to sell 3 investment properties in May and June, and then all of them will give him a capital gain." So we actually gave him a session. I remember it was half an hour, 1 hour session, and have done some calculations for him. And then we actually, at the end, we convinced him to postpone 2 properties to the following tax year, just 1 month or 2 months delay, or change from June to July. That actually helped him to save $80,000 on capital gains tax. Can you imagine that? Yeah, just by delaying the property sales by 1 to 2 months, he can actually save that much. Okay, that's because capital gains tax is actually, or capital gain is actually added on your other income to pay a marginal tax rate. Okay, so by averaging them out to different years, you're actually paying less. All right, and then another example, selling inherited main residence properties after 2 years. So based on tax law, if you're selling them within 2 years, it's actually tax exempt or capital gains tax exempt. But after 2 years, you have to pay capital gains tax. All right, so that's the timing on sales. And then of course there are incorrect timing of expenses. So one example I've listed here. So repair and maintenance cost when property is not available for rental. So it happens quite often that when you have a tenant living in there, there could be damages done to the property, and then you might terminate the agreement first, get rid of the tenant, then you do repair maintenance before the final sales, okay, of the property. What's the issue with that? Okay, so similar, we actually mentioned this at the time of purchase as well. So when you do have a tenant there, or when the property is available for rental, you can actually claim an outright deduction against the rental income in the tax year. All right, but if in case you don't or the property is not available for rental, okay, you can claim a deduction against capital gains tax, okay, against capital gain to reduce capital gain. But the issue here is, remember, you actually, if the property is owned by individuals or family trust, you actually have a 50% discount on the capital gain. Yeah, if you have held the property or owned the property for more than 12 months, you do have a 50% discount. So that means the deduction will be reduced by half. Does that make sense? Yeah. But when you're claiming a deduction against rental income, is 100% of the repair and maintenance, you can claim a deduction. But when you're claiming a deduction in capital gains tax, it's only half. Okay, the deduction is only half, 50%. I hope that does make sense. All right. And then sometimes it could be property owners could be paying too much tax because of lack of support from some tax accountants. Yeah, I think most tax accountants are quite diligent. Yeah, but sometimes because of the understanding of tax law requirements or time strains, yeah, they're just too busy. Yeah, maybe they're not providing enough advice. Okay, but something like this, something I'm going to introduce for about the long-term rental property or investment property planning. That's actually our specialty. I don't think it's provided by many tax accountants. Yeah. So some possible issues here. Okay, sometimes a tax accountant might only introduce pros and cons on different structures, but they don't actually give you the final figures or a solution on the structure. Okay, so say for an example, people might ask, what's the pro? Should I put my property in a family trust? And then the accountant will be giving advice. Okay, what's the pros and cons? So exactly as what we have mentioned in the other YouTube session, the difference on different structures. All right, so that's common advice, and then the client might take the advice away and then to make a decision. But that's actually not enough. Yeah, we'll explain a little bit later, because it's still not going to give you the final comparison. Okay, and then also possibly sometimes accountants don't provide long-term planning with the combination of income tax and capital gains tax considerations. Okay, so we mentioned earlier income could change with the family members, and sometimes the tax planning strategies could be in conflict with each other, yeah, between income tax and capital gains tax. So without considering all different scenarios, how would you know you're actually choosing the best scenario, the best structure? Okay, that's one issue as well. And also, we noticed before that sometimes accountants don't provide cost-benefit analysis. Okay, one example I've listed here, an accountant might tell the client that he shouldn't change the ownership structure because of capital gains tax and stamp duty payments. Okay, because when you have to change, or when you want to change the ownership structure, let's say for an example, from individual ownership to a family trust structure, okay, then because of ownership change, at that point of time, you do need to pay capital gains tax and stamp duty, all right? But people, once they know, okay, I have to pay extra cost, then sometimes the accountant also tells them, don't do it. But what if, my question will be, what if they can actually recoup the loss in a few years? Let's say they change to the family trust. Maybe within 3-5 years time, they actually got the loss back. Okay, they actually earn or save more tax. That's enough to cover all the cost and the changeover. All right, then also that's actually going back to the long-term planning. Okay, all right, so this is actually our solution. I think it's our specialty so far as I know at this point of time. I don't think, well, this is actually my invention. I don't think any other accountants are providing this report yet. Yeah, we might start to introduce to our fellow accountants. Okay, so basically what we're doing is based on the information you provide to us, we actually help you to do this calculation. To compare different scenarios, long-term scenarios as well. So let's say for this particular one, the property will be held for 20 years. Scenario one will be individual ownership, 90-10 split between husband and wife. Scenario two, also individual ownership, but the split will be 50-50 between husband and wife. Scenario three will be 100% going to a family trust. Scenario four will be SMSF, self-managed super fund. So then we actually help you to do a long-term planning, based on the information you provide to us, and then also estimated future sales price and sales cost. So as you can see, the top chart, what we listed here, that's the total tax saving, for combined, income tax and capital gains tax combined. And then one thing I need to mention here, if there's a change over, let's say if there's ownership change, you're transferring the ownership from one to the other, we will also add the cost here when we're preparing this report. We'll add the cost in any particular scenario once when you want to change it. And also at the same time, we add our accounting cost and auditor's cost as well. So that's included because self-managed super fund need to be audited. So all the costs will be included in our scenario calculation. And then, for example, this one here, you can see if the couple have chosen a wrong scenario, scenario three, they need to pay about $70,000 tax for the whole life of the rental property. If they have chosen the right one, they're going to save $80,000 tax. So that's quite a big difference. And then we also provide a breakdown of taxes. So the blue bar, that's income tax saving. That's how much you can save from year to year from the rental tax profit or tax loss. And then the orange bar is actually on the capital gains tax at the end, how much tax you need to pay. All right. So, and then from this report or the charts, you can actually have a one glance comparison on all different scenarios. So which scenario will give you that long-term tax saving or will be the best for your tax? Of course, this is not giving you the final answer, because other factors you also need to consider include asset protection, or succession planning, because we did have cases before. Sometimes clients know, this scenario will give me, say, $30,000 tax saving, but I'd rather give it up because I want to utilize a different scenario purely just for family asset protection and succession planning and estate planning. But that's a different scenario, different factors you need to consider. But the main point here is you need to make informed decision. So once you have this analysis done or this comparison report, at least you know each scenario, how much tax you're going to save, how much tax you have to pay. Then based on that, you can actually make a final informed decision. All right. So that's the end of this presentation. Here are our contact details. If you have any questions on this session, please feel free to let us know. Send me an email, give us a call. And thank you for your time attending this session.